All right, welcome. Today we are diving deep into some of the most persistent, most documented, and honestly, most fascinating anomalies in the stock market. We're talking about strategies that seem to find a real edge where, conventional wisdom says there shouldn't be one. We're going to be pulling right from the Quant playbook 15-1 trading strategies to break down exactly how these things work. So, let's get into it. So, the first big question we really have to ask is this: are stock prices truly random? I mean, for decades, the dominant theory in finance has basically said, yeah, for the most part, they are. The whole idea is that the market is just so darn efficient, it's impossible to consistently get an edge. But is that really the whole picture? You've probably heard of that idea. It's called the efficient market hypothesis, or EMH. It's really the bedrock of a lot of modern financial theory. In a nutshell, what it says is that all the known information, every news report, every earnings call, is already baked into a stock's price. So you can't use that old information to predict where it's going to go next. But what if the data tells a different story? Today, we're going to look at 4 powerful phenomena that seem to poke some serious holes in that idea.
Let's kick things off with our first big challenge to the EMH. It's a fascinating and incredibly powerful concept called momentum. And what it does is it flies right in the face of that random walk theory by suggesting that sometimes, just sometimes, the past can be a surprisingly good predictor of the future.
So what is price momentum? Well, you can think of it like inertia, but for stocks. The core idea, and this is backed by mountains of data, is that stocks that have been doing well recently tend to keep doing well. And on the flip side, stocks that have been doing poorly tend to keep doing poorly. It's almost as if it takes time for the market to fully absorb good or bad news, creating this trend that just carries the stock along for the ride. Okay, so how do you actually trade this? How do quants turn this idea into a strategy? Well, the basic recipe is actually pretty simple. First, you pick your playground, your universe of stocks. Let's say it's the S&P 500. Then you just rank all of them based on their past performance. And finally, you pull the trigger. You buy the top performers, the winners, and you short sell the worst ones, the losers. Now, here's where it gets really clever. The nuance is in how you define past performance. See, quants don't just look at the last 12 months and call it a day. They use what's called a 12-month formation period to do the ranking. But, and this is the key part, they throw out the most recent month's data. They just ignore it. Why? Well, this skip period is absolutely crucial because data shows that in the very short term, stocks often reverse. That noise can totally mess up the longer-term momentum signal you're trying to capture. And when we say performance, what do we actually mean? Well, there are a couple of ways to slice it. You could just use the cumulative return, which is basically the total return over that formation period. Simple enough. Or you could get a little more sophisticated and use a risk-adjusted return, which looks at the average return you got for the amount of volatility or risk you had to endure. But hang on, momentum isn't just about what a stock's price is doing. There's another flavor of it, and you could argue it's even more fundamental. It's called earnings momentum. And instead of just looking at the squiggly lines on a price chart, this strategy looks directly at the company's actual business performance, specifically its earnings. It's a bet on the health of the business itself, not just what the market thinks about it. The secret sauce here is a metric called Standardized Unexpected Earnings, or SUE for short. It's a really smart way to figure out just how big of a surprise an earnings report really was. It takes the latest quarterly earnings, compares them to the same quarter last year, and then it adjusts that difference based on how much those surprises have historically bounced around. So a huge positive SUE score means the company didn't just beat expectations, it absolutely crushed them. And the bet is that the market will slowly wake up to that good news, causing the stock price to drift upwards over time.
Okay, so that's momentum in a nutshell, this idea that trends tend to stick around. But you know what? The cracks in that efficient market wall, they don't stop there. So now let's shift gears a bit, away from market trends and toward the fundamental DNA of the companies themselves.
And first up, we've got a true classic, the value factor. The big idea here is simple. Find companies that look cheap on paper compared to what they're actually worth. A really common way to measure this is the book-to-price ratio. A high ratio basically says the market is valuing the company for less than its net assets, making it a value stock. The whole thinking here is that investors tend to overreact. They get way too pessimistic about bad news or way too hyped up about glamorous growth stocks, and they push prices to crazy extremes. The value strategy is just a bet that eventually things will snap back to reality.
Now, get ready for an idea that completely flips one of the most basic rules of finance on its head. I mean, we are all taught from day one that if you want a higher reward, you have to take on higher risk. It's just the way it works, right? Well, what if the data says the complete opposite is true?
And this brings us to the low volatility anomaly. And the finding here is as clear as it is mind-bending. On average, portfolios made up of stocks with low historical volatility have actually delivered better risk-adjusted returns than portfolios of super high volatility stocks. It makes you go, wait, what? So why on earth would this happen? Well, one theory points to the way institutions work. A lot of fund managers are almost forced to buy risky stocks to try and shoot the lights out. Another idea is the lottery ticket effect, where investors just overpay for those volatile stocks, dreaming of that one huge payoff.
So we've got these four really interesting anomalies, right? Price momentum, earnings momentum, value, and low volatility. But just knowing that they exist is one thing. How do professional quants actually go about building portfolios to try and capture these effects? Okay, let's open up the toolkit and take a look at the mechanics.
All right, so a really critical concept here is that these strategies are almost always implemented using something called a dollar-neutral portfolio. And all that means is that the total amount of money you invest in your long positions, the stocks you're buying, is perfectly balanced by the total amount of your short positions. So why do that? Well, it's designed to take the overall market direction out of the equation. You're trying to isolate the performance of the strategy itself. This way, whether you make or lose money, it depends only on if your winners did better than your losers, regardless of whether the whole market was up or down that day.
So once you've figured out your winners and losers, you still have to decide how much money to put into each one. The simplest approach, just use uniform weights, but the exact same dollar amount in every single stock. Easy. But a more advanced method is to suppress the weights by volatility. This just means you put less money into the more volatile stocks and more into the stable ones. The reason is pretty clear. It's a risk management tool. It helps stop one single crazy stock from blowing up your entire portfolio's performance.
So, after all that, where does this leave us? We've walked through some really compelling evidence for momentum, for value, and for low volatility. And it is so important to understand that these are not just some quirky one-off ideas. They are persistent, data-driven patterns that have been studied for decades across markets all over the world, which really forces us to ask the question, are these actual cracks in the foundation of the market?
So let's just quickly recap the four big cracks we looked at. You've got price momentum, where winners just keep on winning. You have earnings momentum, where good news has a surprisingly long shelf life. You have the value factor, where cheap has historically beaten expensive. And finally, the low volatility anomaly, where safer has actually been stronger. Every single one of these is a systematic, data-backed challenge to the old idea of a perfectly efficient market.
But before we all run off and try to implement these, we need a serious dose of reality. And this quote from Jean-Philippe Bouchout, who is an absolute legend in quantitative finance, just says it all. Knowing about an anomaly and actually making money from it are two completely different things. In the real world, you've got transaction costs, you've got something called slippage, which is the tiny difference between the price you wanted and the price you got, and all these other frictions can chew away at or even completely wipe out the theoretical edge of these strategies.
And that, of course, leaves us with the million-dollar or maybe billion-dollar question. If these patterns have been studied and written about by academics and quants for years, why haven't they disappeared? Why haven't they been arbitraged away? Is it because of some deep-rooted human biases like our tendency to underreact to news? Or maybe it's because of real-world limits like trading costs? Or is it something else entirely? That right there is the puzzle that keeps the market endlessly fascinating.